Hi, my name is Adam Pucci. I'm the founder of Merchant Money, and today we're going to be talking about revenue-based financing, which is a common transaction that's called merchant cash advances in the small to medium-sized business lending world. We're going to talk about some of the key terminology you're going to see in your contract, and then break down the payment amounts that you'll be required to pay back the lender after the transaction is funded. So let's start off with some of the key terminology. There's going to be 4 terms that you'll most commonly see in any MCA, merchant cash advance contract. The first one is going to be the purchase price, and that is going to be the amount that the lender funds your business. The second term is going to be the amount sold. This is going to be the total amount that your business is required to pay back the lender. And then there's going to be another term called the specified percentage. We'll dive a little bit more into this a little bit later. And then the final term you'll see is called a turn or term. This is going to be the number of months that your contract is good for, the total number of months you're supposed to pay back the lender. So running through an example, let's say your business qualifies for $100,000 cash advance. Okay, that's going to be the purchase price. The lender is going to say, all right, after doing our underwriting, we determined that you are going to be required to pay us $120,000. That's going to be the amount sold. The specified percentage in this example, just to keep it simple, is going to be 10%. So in theory, 10% of your revenue that's generated by the business each month, 10% of that revenue is going to be applied towards the $120,000 amount sold. Okay, we'll get a little bit deeper into that in a second. And then for this example, let's say the lender gives you a 12-month term. So your contract in theory should be completed within 12 months. And let's break this down by just the payment amounts that would be due each month, each week, and each business day. You will never be paying on the weekends. So your monthly payment amount would be $10,000. This is calculated by taking the amount sold, dividing it by your term, which in this instance is 12 months, okay? And then and then that will give you the total monthly amount you're required to pay the lender. You divide the $10,000 by 4, break it down on a weekly basis, it's gonna be $2,500. Divide it by 5 business days a week, that's going to come out to $500, okay? And this is not necessarily a fixed amount. We're going to talk about reconciliation in a little bit, but let's just use this as our example. Okay, so you would be required each business day to pay $500 or each week $2,500, as these 2 payment frequencies are the most common payment frequency that exists with a merchant cash advance. So it's either going to be a daily payment or a weekly payment. Now, a lot of people say, well, what does this 10% have to do with anything if the amount is not fixed each month or each week or each day? So the great thing about merchant cash advances is that the lender is purchasing your future receivables. Now, what that means is, in theory, they are only going to be paid if your business is generating revenue. And we'll talk about how the lender determines what your affordability is each month by looking at your cash flow. But in this video, we're just going to focus on breaking down that. So let's say your business generates $50,000 on average each month. And that's going to be your revenue, just your gross revenue before any expenses. Okay. Now in this example, each month you're required to pay 10% of that $50,000 that was generated in the given month. So that would be only $5,000, right, per month. Now, you're gonna say, well, you just told me 10 seconds ago it was $10,000. These are approximations of what you would pay if you were on a fixed payment plan, like a general loan, right? But because they're purchasing your future receivables, and this is not a loan, you are only required to pay whatever the specified percentage is in your contract compared to what you actually generate in revenue each month. So this process is called reconciliation. And reconciliation really only applies to merchant cash advances, which is one of the biggest benefits for merchants. So let's say you have a bad month, okay, and you only generate $25,000 in revenue in that given month. Again, your specified percentage is only 10%. So in this month, you are only required to pay $2,500, okay? But because you're on this fixed plan, which is an approximation of what you would pay if you were on a fixed plan, that is substantially lower than the $10,000. There's a $7,500 difference there. Okay, now you can use that $7,500 as a quote unquote overpayment and apply it towards your $120,000. But let's say you need the extra cash on hand for whatever reason that given month. You can request from your lender or your funder a reconciliation for that given month. Now, what that looks like is you will need to email your lender your most recent business bank statement for whatever month you want the reconciliation done for. Now, they're going to do essentially the same thing they did when they were underwriting your transaction before you got approved for the merchant cash advance. And they're going to say, they're essentially going to verify that you only had $25,000 in revenue for that month. Okay. Now, once they verify that the $25,000 was the actual revenue for that month, and you paid $10,000 because that's an approximation of what you would pay, they're gonna come back to you and say, okay, there is a $7,500 difference here. Do you want to apply that $7,500 towards the amount sold, which is $120,000, and leave it just the way it is? Or do you want a quote unquote credit for that $7,500 difference? And if so, we will apply those funds back to your business bank account. So in essence, this is the reality of cash flow for a lot of small and medium-sized businesses. Right? You're gonna have good months, you're gonna have bad months. If you get a merchant cash advance and you have a bad month, you're only required to pay whatever the specified percentage is of your given revenue in any month. So if you do have a bad month, you can always choose to do a reconciliation, which is not included or a part of a business loan, which again makes this a huge incentive for merchants. So really, if you have a bad month and you have multiple bad months, your term, which was originally 12 months, this is the anticipated term, the time it would take to pay back the merchant cash advance, is going to be extended for an indefinite period of time because you won't know what your cash flow is going to be in the future. So this is a basic overview of revenue-based financing, aka most commonly transaction is a merchant cash advance. These are some of the key terms you'll see on your contract. This is how you'll calculate the monthly, weekly, and daily amounts that are due towards the lender. And this is the reconciliation process that you always have the option to engage or request from the lender in order to adjust whatever your actual revenue and payments due in that given month. Thank you, and we'll see you next time.